John said you either know something or you do something different, right? One of the two. So I say you're much better off doing something different than knowing something. Knowing something's ephemeral, right? It's very hard to know something for very long that other people don't know.
Mm-hmm.
So, but doing something is a flywheel.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How's it going, bud?
I'm doing good. I got the 2018 Bitcoin craze, and I was texting my buddy, his brother, who was, he's like this crypto guy, and I said, "Do you still have that money I gave you?" He's like, "Oh no, all the things are worthless." So I was going back to old logins. I'm up like 60% in Bitcoin from 2018. I didn't even know I owned it. I thought it was all gone. So I found it today at $1,500, right? It's not a lot of money, but I was going back through, I was able to download a summary. So I found $1,500 today. I feel like a pig in shit.
Oh, that's good. I mean, I don't know if that's the best advice you'll ever get, but at least you found something you didn't have before. That's a good day. It's like finding $20 in your jean pocket before you put it in.
I felt the same way because I was it's funny. The market's been going crazy, right? And obviously we're not, a stock, we don't talk about that stuff, but I've sold everything over the last 24 hours because who the hell knows what's going on. So I was like, you know what, let me find out about this other shit. And, long story short, like I said, I found, exactly $1,400.62. So I felt, the day couldn't get any better.
Yeah, no, I was happy. Tesla ripped up again yesterday. I've had that thing forever.
See that.
Been doing very well. So I was very happy. Very happy.
I have a trailing stop order in there. That's the only one I haven't sold yet because it keeps going up.
Yeah, it's crazy. But we are a real estate podcast. So let's get into today's episode. We got a really great guest on today. I think it's going to be an awesome conversation. I think he's going to have some awesome insights and experience to share with us. So with that being said, Ben, thank you so much for coming on.
Yeah, thanks for having me.
Awesome. So you want to kick things off? Just tell everybody a little bit about you, your background, journey, what you do.
Yeah. So my name is Ben Miller. I'm CEO and co-founder of Fundrise. I've been now 20 years in real estate. I think I've done something between $4 and $5 billion of real estate deals. So I hope I've learned something over the years. So background from Washington, D.C., from a real estate family. And so I've been doing real estate since I was a little kid.
Nice. So that's actually interesting because we don't get a ton of people that come from a real estate family background. I think we had, I forget his name, the guy up in Cleveland, John, if you remember, chime in. But what was it like growing up in a real estate family? Because I think anybody that's listening who wants to get into real estate is probably wishing they were in your shoes. But what was that like?
Yeah, I think I benefited from it. My father was a real estate developer, and I feel like it gave me a longer term perspective because back in the 80s, real estate was so different. The things that that were normal to him back then, like 110, 115% loans.
Oh, wow.
Takeout financing. Most things were built with a takeout or a pre-commitment to buy before you start construction. Most of the players were SNL, savings and loans, and insurance companies. Mm-hmm. There were no private equity funds really. They didn't exist till the early 90s, and everything was basically syndication. Everything was individuals investing. There was almost no institutional money, and that was just like how it was. And then the SNL Crisis blew up the real estate industry. It was worse than 2008. Ended up, the government formed Resolution Trust Corporation, took over the entire real estate industry. At one point, I think the RTC owned 200,000 properties.
Wow, that's a lot.
Yeah, it's crazy, right? And so, and actually, I know a little bit about this, and from my father, and also from a couple of people who were there at the beginning. And so, the RTC, the government, really birthed the real estate financial industry we know today. Mm-hmm. Because when they went to sell properties, right, they had okay, now we own 200,000. Now we own all these properties because they seized all the banks, SNLs back then. So they're well, they can't sell, 200,000 properties one by one.
Yeah.
So they started selling them in huge like pools, like 1,000 properties in a pool. And like there was nobody on the street big enough to like buy 1,000 properties.
Right.
So the first like pool was bought by like what became Goldman's Whitehall and Blackstone came together with this guy named Joe Robert, and they had to create a pool to buy a pool.
Right.
And that pool, which we now call private equity, is what bought the first RTC sale. So like the private equity basically like comes out of the RTC crisis.
Wow. That's wild, because we talk a lot about, I'm 28, so you're talking about things, well before my time, and John's only a few years older than me, and we've only been in this, me 5-6 years, John's probably closer to 10, maybe a little bit more. I mean, for us, it's always been private equity, syndication, huge funds managing it. I didn't even realize that that's how these things develop. So you've kind of seen it a little bit. I don't know how old you were and how involved you actually were. You've kind of seen it mature to where it is today. We are always like, oh my God, I can't believe how many new players are coming into the space, how much money is funneling into the space. Like, it just feels crazy. And I'm talking about a 5-year timeline. You're talking about 20, 30 years. How do you see the market then of all these new companies cropping up, all these new syndications, all these new private equity spaces, and, so much foreign capital pouring into this real estate market, which, has a shortage nationally and can't really keep up with demand?
Yeah. I mean, I have two main thoughts on that. One is that, everything moves in cycles. And so we're like at a mature stage of the way things are. And it probably means that there'll be some shift and it won't be like this anymore. And like, you'll talk to your kid like 25 years from now and you're like, you won't believe what it was like. It won't be anything like it is today.
Right.
So like, does it either blow up like it did in the sort of late 80s, early 90s and completely collapse, which is like one possible play out of the way that the Fed and the system just keeps bailing everybody out and keeps piling on debt. Or the alternative is it looks more and more like the public markets, right? Where it's just like tons of efficiency, right? There's I mean, if you go back, even in the beginning of my career, 20 years ago, I mean, there was so little information about deals. There was no Google Maps. Like off-market deals were regular. I mean, the number of truly off-market deals I see these days are so few. Everybody has all the information. Every deal's like auctioned. So I feel like the real estate market starts looking more and more like the public markets, which is like a very efficient space. Like if you think about the public markets used to be built around hedge funds. Hedge funds are a lot like private equity funds. They're like these, they seek alpha, and they just getting crushed by Vanguard.
Right.
And so I think something like that happens to the real estate industry. Like as technology starts to like make its way into the sector, the way institutional players in particular, like find alpha and then strip alpha from the deal becomes less and less like tenable.
What do you mean by finding alpha? I think I understand, but I just want to clarify.
Well, I mean, I just take a traditional real estate player like a Carlisle or Starwood. Their whole pitch is that they're able to find like great deals, which essentially means information asymmetry. Like they know something, they have some edge, and that edge like translates to better returns, and that's alpha, right? That's like I think that narrative is like it's less and less true. Right? There's just so little alpha in like what these private equity players are doing when they find a deal and they somehow like buy it at a price that like someone didn't know it was like a good deal. I mean, the chance of that is still unlikely these days. So I think that's like more of a narrative to raise money than actual like a practice.
So
go ahead.
It's funny because I talk about that. Two things that you brought up that I think are so true. One, the real estate space in general is it's like behind the times when it comes to technology, right? It's just so antiquated, and that's changing daily, right? Even what you guys are doing, on the cutting edge there. Even the residential space. It's such a you're middle-aged, woman is a real estate agent and she went through a class, and it's not in the, in 2020 or 2021. And that's changing daily. The other thing is, I talk about it with Chris all the time. When we look at what we do, we are not unique. There's millions of us. And I always say, if we did something different or we knew something different, that gives us a competitive advantage. And I think that competitive advantage, because of technology and because everything's changing, is becoming harder and harder to find. There are less off-market deals and they've been shopped, or, all the information is public, and guys send financials to this. So that like little core group of used to be, the country club guys, and there was the real estate guy there, and his 5 friends gave him money and he went out and bought a deal, because it wasn't like it is today, where you could go online and understand what a cap rate is, or go online and get a spreadsheet to underwrite it. It's like the stock market, when you could not go online to check your stocks. You had to get the paper the next morning and flip through it. That's been real estate really up until the last 5 years, maybe 7 years, where, Zillows and companies like that started changing it. So I think that as that becomes, you're right, that competitive advantage, you have to do something different. And it might be your pitch, but you got to sort of figure out how to integrate that so you are different, or you are doing something, or you just got to find a deal that nobody has. And those are the two things that I see, that I talk about all the time. So, coming from someone like yourself, it's, it's true. And that's where, this business is sort of changing, and it's changing quickly.
I guess the one thing that I think about still, and I'm curious to hear your take, is, real estate is still very much a local market, right? It's tough to make it highly national unless you aggregate across tens of thousands of units. And it's still very much you're buying a business that has operations, and everybody's going to do it slightly different. Obviously, it's becoming more cookie cutter, and it's very easy to just kind of do it the standard way. But I guess one of the things that I personally see still having as a differentiator is being a better operator than other people, especially if you're vertically integrated, or you have a management partner, or you have construction partners. That's still got to be the thing that sets you apart in today's environment. I don't know about 5-10 years from now, though.
Yeah, that's exactly what I think too. So if I sort of like pan back for a minute, I feel like the real estate industry is obsessed with deals, like they're deal centric. Yeah. And it's made up of like acquisition people, mostly acquisition guys, and finance. Mm-hmm. But so John said, you either know something or you do something different, right? One of the two. So I say you're much better off doing something different than knowing something. Knowing something's ephemeral, right? It's very hard to know something for very long that other people don't know. Mm-hmm. So, but doing something is a flywheel, right? And so like, this is like when I went from real estate to tech 10 years ago now, tech's all about the flywheel, and real estate's all about the transaction. And so to build a flywheel, you have to build operating excellence, which can be about tech, which can be about building better and better tech, but also can be about knowledge or relationships. Mm-hmm. And so I think that over time, it's gonna be all about the operating excellence, and that's how you actually outperform. And if you don't have operating excellence, you're just like I can pick on the PE shops, which are basically they're really just traders of real estate. They look at real estate the way any financial institution looks at any asset. It's just like an asset to get in and out of. That's going to become, there's going to be like no alpha there, no better returns than just like buying Vanguard.
Mm-hmm. Yeah. I mean, the amount of capital, and even now into the, quasi institutional level, that is, I don't want to say churn and burn, but is looking for, 1 to 3 year horizons, or, 2 to 5 year horizons, is just pretty crazy in my opinion. And, real estate, it would say, is more traditionally, longer term span, things that take time, they don't come quickly. And now people are trying to get in there and basically flip multifamily. It was crazy. There's a funny story. I was shopping a deal as a tenant for a deal we were buying. And I just told her, I was like, hey, I'm a flipper, I'm moving, just want to see a place. And I always say, like, I do some in real estate, because if I ask questions, I don't want them to be like, who are you? And at the end, she's like, oh, like our owner actually flips multifamily. I'm like, oh my God, what are you talking about? And she's like, there's actually a seminar you can go to when you move here where you can learn how to flip multifamily. I was like, oh my God, this is ridiculous. So the fact that I have a property manager for a deal on blind shopping as a single family flipper telling me I can flip multifamily, it's like, she's got to be telling that to every other person. And it's like, this is just how that idea or thesis kind of matriculates into the general population. And obviously it's now in, the more institutional capital as well. So it's kind of interesting for me to see that play out because it's just everywhere online and everybody's idea of get in, get out, kind of slap some lipstick on a pig and, let's just get our nut.
Yeah. That's such a scary story. And so so the good and bad of being like 20 years in is now I've done 3 crises. So I did 99, 01, and then 08, now 2020. I didn't do 92, which it was the mother of all real estate crisis, thank God. But I remember 05, 06, 07. And that's basically what was happening, right, with the housing business. Everybody was in it. Everyone was flipping it. There's tons of leverage. And so like that kind of story you just told was like the kind of story back, that the Big Short would like talk about. Yeah. Be like, how come nobody knew this was a bubble? Everybody, like some random, property manager with no, financial experience was like talking about flipping this asset. So the signs are there.
Yeah.
That we have basically there's an oversupply of money, and that's because the government's printing money. Mm-hmm. And so and last time there was oversupply of money because there was too much leverage in the system. That was the 08 crisis was just like hidden leverage everywhere.
Right.
And so there's oversupply of money. And there's just now, they just increased the base money supply by $3 trillion, in March, and they previously increased it by $3 trillion in 08, 09, 10. So it's just, so what do you do in a world where there's oversupply of money? It makes me nervous as somebody who's just like seen it go bad, and I have like these scars that like affect me.
Mm-hmm. Is that what happened in is that what happened in the SNL crisis, or was it different?
Yeah, it's always essentially oversupply of money. Like the Mises law, right? There's that the lenders oversupply money, which causes price to go up because you can borrow more.
Right.
And if you borrow more, the price goes up. So if the price goes up, it means you can borrow more again because it's LTV. Mm-hmm. So then you can borrow more, which you buy more, and then you pay more, and you borrow more, and it goes up and up and up. And so, and then multifamily cap rates. My father, we talk about, he'd build to a 12 return on cost unlevered, and I'd be like, "Ooh, maybe we could get to like a 5. Oosh, that would be amazing." He's like, "What are you talking about?"
It's funny because I've spoken to a ton of developers in the city, and the good ones are like, you build to a 6 and you win, right? It's like it's just crazy that's where it's come to. But and the one thing that I look at, and we just did this, we just bought a mobile home park. I'm taking that leverage risk off the table. So we're buying deals in cash because okay, yes, I'm not going to put a 30 on paper, but I could show you a really good, double-digit deal, or in that range, but it's cash. So the biggest risk and your biggest exposure, you're taking it off the table. So yes, did we buy 100 deals last year? No, we bought 2, and we really didn't buy any. Or this year, the really deals that went in contract at the end of 2019, because I just have no, just because I could borrow more money for cheaper does not mean I should. And, all these brokers and all these people are like, they call you and they're, well, if it's a down the fairway agency deal, it'll sell at a 5 cap or a 4.5 cap. And I'm like, yeah, I know, but just because you could get the money doesn't mean you should, or it makes sense. And at some point, everything that goes up must go down. Who knows when, but, I see the debt as the risk mitigator. And that's how we're looking at a lot of opportunities. I just got a deal, in Jacksonville today that, $7 million all cash. I'm like, okay, well, I could take the risk off the table significantly. The average rent, $600 is across the street from a property where our average rent is literally $900. So it's like, okay, I feel good about stuff like that.
Yeah. I think even just the other deal we got where it was, $22 million a year and a half ago, and, loan assumption.
A year and a half.
Yeah. And now it's
February. We offer in February of this year.
Oh, it was this year? I thought it was last year.
So I was looking back through the pipeline. In February of this year, we got a deal sent to us. They wanted $24 million. We offered like 22. think it was 22.1 is what we offered.
Something like that.
8 months later, we're sitting here in November. They said to get sort of close, you got to put a $27 million number on it. And it's like, okay, well, over the last 8 months, how'd the property go up 30% in value? But the economics have changed, not in the favor of the deal, except for debt is almost free, but that doesn't make the deal more valuable. And that to me just blows my mind.
Yeah. So the one argument I do hear, and I don't really have a good knowledge of this, but Ben, I'm curious if you've thought about it at all, is, obviously other countries are going with negative interest rates and they seem to be doing fine. The kind of paradigm of that might be the wrong word, but Japan kind of just humming along, doing well, having negative interest rates. And obviously if debt continues to go down, if you're just trying to make a spread and make cash flow, therefore technically your cap rate could go down if that was your goal. How do you think about that argument of, kind of backing up where this has been heading the last 10 years?
It's very persuasive. I've obsessed with this topic now because let me come back to your question with like just how I think about it, and then because it's really a macro question, and in 2008, like I was in real estate, I was a sponsor, we had development deals, and everything blew up, right? And like my takeaway from 2008, one of them was that like the macro swamps the micro. Like I don't care how good a deal you bought that deal for, supposed to be 27 million, and you bought it for 22 million. You can't believe how you got 30% discount. And if that deal had been like the wrong kind of deal, it could have been, hotel, right? Right now you'd be destroyed. The macro crushed it. So basically if you get the macro wrong, you're dead. And so I previously I was obsessed with like the micro. So the micro are like the price, it could be the operations and expenses. It could be like the physical plant or like the design. Like I was a developer, so I was like obsessed with like what are the lines of sites and what's it feel like, what's the experience. But and so then I came out of 08 being like, okay, well, like what's the macro here, and can I get on the right side of the macro? And so you're talking right now about macro drivers, like what interest rate environment is actually an outcome of macro, and the typical macros are demographics, technology, globalization, pandemics, and war. Those are like historically the macro drivers. And when I used to say pandemics, people were like, "What are you talking about?" Right? So, demographically, like Japan and all of the developed world is basically in decline. Like there's less people born this year than last year in terms of like the population of Japan shrinking, and also the population's aging. So like 20 years ago, 7-8% of countries over 65 in the United States. Now it's 17%. It'll be 25% in 10 years over 65. So aging population, the shrinking population is massively deflationary.
Yeah, I've thought about that before of like, everyone says like, oh, everything continues to go up and up, but doesn't things continue to go up and up as long as the population continues to grow? You have more consumption, more production. If the population starts to stagnate or come down, there's just going to be less possible. And once you have that aging population, most people over 65 aren't working. Either one of two things are going to happen. They're going to either have to continue to work, or the smaller population is going to have to support a larger aging population. And it doesn't seem like it's going to be possible. I mean, now we're getting into, high level, crazy economic stuff that I don't know anything what I'm talking about, but it is always something I've thought about of, the 60s, 70s, 80s, people were having way more kids. And now it's like kind of I think the average is like 2 or 2.2 or something like that, which obviously, keeps it the same. But if you start going in that other direction, it's, what you're talking about in Japan, basically.
It's actually less than that. It's only 2.2 because of immigration.
Gotcha.
Without immigration, it's less than 2. And so we're a shrinking country without immigration.
Interesting.
And so, I mean, the problem with macro is it's really difficult to like get your arms around. Like this is the challenge. So like you go to the micro because it's clear, it feels more certain. It's like more linear, if you will. And then the macro is like ambiguous, it's uncertain, it's nonlinear. And so you sort of like your anxiety wants to have you do things that you can like kind of feel like you have some certainty, but the certainty is an illusion. Right? The whole thing can blow up. It will blow up. And so even though the macro is hard, in some ways it's not as difficult as it seems if you just do the simple macros. So if I was like my original background, I was an urban infill retail developer, mixed use retail, and retail has been destroyed. Right. That macro is not that hard to see. Like, don't go into retail. Don't buy retail.
Right.
Okay. Don't like hotels, Airbnb. I mean, they're smashing it. You know, so you can look at the macros and make some pretty basic assumptions. And then if you and they're based on your experience. Like, are people now, like when I went into real estate in 2000, there's this massive macro trend from 2000 to 2019 of people moving into the cities. There's a Brooklynification of the cities, and that was an awesome macro. And that macro like came to like almost a stop in 2016, 17, and then reversed in 2020.
Yeah.
And you can feel pretty good that the next 10 years, like, you want to be not in the, big dense cities. I think that's like a really good macro. So I think that you can't know the macro, but you can basically like be on the right side of like the headwinds. You want to be on the tailwind. Yeah. And and as a real estate investor, you have to do that. You have to think about that. It seems so simple. People don't do it. People still buy a great. I mean, I was looking at malls. I mean, a mall traded yesterday that was $300 million in 2008, $185 million in 2014, and it foreclosed on at $55 million, probably worth $35 million.
Wow.
Right. I mean, like, that's not financial modeling. Like, that's not operations. That's not anything micro.
It's true. No, it's a really good point. And I think that's really interesting to see what's going to happen with all those spaces, because they're obviously, I'm sure that's hundreds of thousands of square feet. I know people are turning them into apartments, data centers, fulfillment centers, all that stuff, getting creative. But I do want to talk a little bit about the macro trend of the urbanization, the work from home, living an hour and a half outside cities. Because I look at it two different ways, and I'm curious why it sounds like you're leaning more towards the way of it's going to change. A lot of people are talking about 2001 after 9/11, and it was like nobody's gonna work in high rises, nobody's gonna want to be 120 stories up. And John's partner, was an office leasing broker for Cushman and Wakefield, so he's intimately knowledgeable on when this happened. And he said, at first nobody wanted to do it, and then after a couple of years, everybody wanted the top floor and wanted to be the big dog again. So I guess for me, sitting here thinking, and it's interesting for me as well, because I'm one of those people that I lived in Brooklyn. I like living in the city. I'm all about, walking to things and doing that. So for me sitting here, I'm not like, hey, I'm never going to go live in a city again. I'm like, when's this going to be over so I can go back to living in a city and kind of have that lifestyle again? But I understand that's not going to be true for everyone. I almost see it as like kind of it'll be a shift back, but not fully a shift back, where it'll be, there are going to be those people that live an hour and a half outside the city. They work from home, 3-4 days out of the week. They go into the office 1-2 days, and they're willing to drive a little bit further to kind of do it, or they work fully from home and they want that space, cheap living, whatever. But I do think there's going to be, people that like that urban lifestyle and things like that. So it's just not going to be as big as it was. How do you feel about it at all? And like, why do you think it's going to be a larger shift maybe?
Yeah. So I think about it. You have to think about it in terms of flow, not stock. So the stock of something is how, like, you look at the stock market, people are like, oh, it's $100 trillion, whatever it is. But the capital flows drive the price.
Right.
So there's more flows in because of the printing money and because of Vanguard passive investing. So it drives price up. So in real estate, like the renter, which is primarily the driver of real estate, like, you have to look, well, are the flows going to be like net positive, net neutral, net negative? And so you said, well, over what time period? So if you're saying like over like 24 months, yeah, I think there's like some reversion back to the mean.
Mm-hmm.
But over 10 years, I think you're up against two macro drivers that are like going to be a slow erosion of urban performance in terms of just pricing value. Mm-hmm. One is that if you look at the demographics, the millennial generation, basically echo boom, biggest generation in history, that generation's like, I think the peak of it is around 28 or 9.
Mm-hmm.
And that generation like is going into their 30s, having kids. And so going to move out of apartments into housing. And now they can, like they were sort of stuck because they couldn't move to the suburbs and keep their jobs very easily.
Mm-hmm.
And so there's just like this demographic drive around like, people having families or driving the suburbs. And then the number of people in the next, the sort of the 25-year-olds is actually less. So you have less people. There's like a decline in demographics.
Mm.
So less 25-year-olds means less, people renting those $5,000 apartments in Brooklyn. Like
Mm-hmm.
it's a demographic decline. So that's like one. And then two, I just look at the 10-year technology. Do I think work from home technology is going to get better over 10 years? Do I think like driverless cars will get better over 10 years? Like, do I think the technological trend around this will basically make the suburbs better or worse?
Mm-hmm.
So it's like the macros, again, this is not really complicated. And if you get to the basics, you say, okay, well, there's really good macros around like, and affordability, right? That this is a country has a problem with affordability.
Right.
You have like middle class is not growing. And so they need to make decisions around affordability. And so all those three things are going to be good for the Sun Belt, good for the suburbs, and bad for like New York, San Francisco, Chicago,
mm-hmm.
just bad for those urban infill deals.
So I'm on the fence about this, Fred. I can easily see both sides of the coin, but I happen to think the technology component is going to, over that longer period of time, going to win out. And, where we live is the perfect example, right? We live in New York, 35 minutes out of the city, and Chris is maybe a little bit further. I would have no problem whatsoever moving an hour and a half upstate or somewhere else, because I don't need necessarily to go into the office, and I could always schedule a day in the city to meet investors or meet with clients or whatever it is. I think as technology gets better, it will drive the affordable component. Even in, my neighborhood, the prices are crazy, where if you go an hour and a half upstate or an hour and a half further south or into Pennsylvania, you're going to buy the same house for half the price, if not more. So mm-hmm. I tend to lean towards the 10-year, even the 3-year or 5-year number, not it going in the wrong direction, because, we lived in an apartment, we moved out. I have a 20-month-old daughter. If I lived in an apartment for what just happened, I would have blown my brains out. A 700 square foot room with at that time, a 1-year-old, it would have been tough. Having a house, a yard, it would have been totally different. So I can easily see the longer term technology winning. But when you look back to what Chris said, that, that 2001, the September 11th thing, it almost felt like time healed all wounds. So it's tough, not going on the record, not putting my neck out there. But Ben, I think you're 100% accurate. I think as technology gets better, it's going to alleviate some people's fears of not being 15 minutes, 20 minutes, 30 minutes at their office. And they could say, I'm fully capable of doing this in my perfect setting, whether it be on a small lake or in a mountain or wherever it is. So I lean that way, but it's an interesting demographic on how it's shaken out.
Yeah, there's like a whole psychological like studies about how people they focus on events like terrorism. Like I remember one, I was working, one, and I have friends, and this is a whole different story. But people, I remember being freaked out about terrorism. Personally, I lived in Washington, D.C. I'd hear airplanes and I'd be like, oh my God, it's happening again. And, but like number of people die in terrorism a year, 10, number of people die in car accidents a year, 100,000. Right. So there's like the psychological effect around events that overly warp how we think about their significance. And that the pandemic has been a lesson in that. Again, I didn't appreciate how much we would rebound and how quickly. And so we rebounded from 9/11 quickly because the macro trends which drove that urbanization. And it was just there was an event that was like an anomaly. So I lived through e-commerce too. So, when I was in retail real estate in the early 2000s, it's like, well, e-commerce is only like 3% of like all commerce. Like, it doesn't matter. Then it was like 4, then it was 5, then it was 6. And that just like that slow technological erosion is what's happening. Work from home 3-4% now. Every year it's going to go up percent, and that's affecting your flow. Like, I've at Fundrise, we have 130 people. Big chunk of them are never coming back to the office for sure. I don't know what it is yet, 20%. And every year I'm going to have more remote workers. Every year I'm going to have to like reorganize the company around that dynamic. And so that change in the flows, the flow of people rather than flow of capital. I just think that it's so inexorable. And and the way it happened, I got crushed by e-commerce. We did okay, but as a macro trend, that taught me like that slow incremental change. So you boil the frog slowly. It's really easy to underestimate it.
Mm-hmm. No, I think it was interesting too, because when I first moved into Brooklyn, lived in a place called Bushwick, and started telling all like my parents and my parents' friends and family. And I started like, it had never come up before. I knew people like grew up there. But every person I talked to was like, oh, I lived here, I lived there, I lived there. I didn't realize it was like 95% of, the older generation from like 50 to 70 on Long Island had lived in the city and grew up there. And they were all like, oh, why are you living there? Like, don't live there. I'm like, it's not the same as it was. And I do wonder if it's this kind of trend of like also doing something different than what you grew up with or what your parents did as well. Because for me, it was like, God, I'm so tired of living in the suburbs. Like, I'm so tired of driving everywhere. Like, it was just like, oh, I can park my car and like walk everywhere. Like, that's cool. Like, I don't want to do that. And I wonder if part of it too is going to be that trend of like, call it the Gen Z is like, oh, we don't want to be the millennials, or we don't want to be whatever, it's going to be slightly different, and kind of just that I don't know if it's adolescent or young adult, like just mind of doing it differently, or, kind of not doing what they grew up on. I wonder if that's part of it too, because you're right. I did say like, okay, everybody's been flooding to the city. Eventually everybody's going to leave because all my parents did and all their friends did it. I just figured it was going to be way longer because it's only been the last, I don't know, maybe 15, 20 years, especially, New York. I can't really speak for other cities that it's, the trend has been moving into it, and, it's been revitalized and revamped, and a ton of capital's flooded into it. So I don't know if that plays a part either.
Yeah. I think there's two really interesting things you brought up. So one is that, Fundrise is like, a B2C business, right? We have a million customers, right? So we're obsessed with the customer. We think about the customer. Our customer is like a 35 to 45-year-old person. So it's not like most real estate investors are 65 to 85-year-olds. Like, they're much older. And so when we think about what real estate we should invest in, we think about like where our customer is, and we have insights around customer, data around customer. So we don't do a lot of B2B real estate because that's where institutional players like have an advantage, right? The customer doesn't matter in institutional, like a build a suit for like some institutional, Fortune 500 company. And so like, I love, like, in my office, people are 25 and they're thinking, like, what are they doing? Like, I had two groups of people who were having families and struggling in apartments. Then I have young people, and if you watch them and see what they're doing, that's a really good, like, it's a Peter Lynch. Peter Lynch always said, like, buy what you use. From Magellan. He was like the first to popularize mutual funds. And so it'll be interesting to see what Gen Z does. I could easily see, if I were 25 and I could work for Fundrise, I would work remotely and like live in Brazil. And then I'd live in like, Malaysia. I would live around the world. Why would I want to live in one place if I could live everywhere and still have a high paying job and still have a really productive career? Like, it just doesn't. So that's nonlinear, right? That's like complete break. And it's hard to predict nonlinear, but you can see that, like, that's that's mighty attractive.
Yeah. I mean, the amount of people that are now like converting vans into their home and working remote and just driving around the country is insane. It's like every week I see somebody that's buying a van and converting it, or bought one that's converted, and they're now going off and living. It's like, it's like the Euro trip that everybody used to do when they graduated high school or college. It was like, everybody would go backpacking for 6 months. That was kind of like the prototypical thing that people did, 10, 20 years ago. And now it's like everybody buys a van and goes and drives around for, a year or two. And it's just crazy,
the next 24 months, they're going to roll out 5G. Right. Yeah. And you won't need Wi-Fi.
Yeah.
Like 5G will be better. I mean, that's just another example.
Shut off Wi-Fi sometimes.
Yeah. I mean, so that's going to just completely change location. Mm-hmm. And that's one of the things about real estate. Also, I still haven't fully like processed, but a lot of what technology has done is made a location less important. And whether it's e-commerce, right? That made retail used to be all about main and main. Right now, it's basically it's industrial or e-commerce destroyed that. Hotels used to be about main and main, but Airbnb destroyed that. I think office work from home, that's going to happen. And then I think that like driverless and different kinds of technology around that's going to affect residential. Mm-hmm. Like the next shock to real estate industry is when residential goes through a technological disruption, and everybody's capping out this residential at 4.5 cap rates because they basically think of it as a permanent cash flow. Mm-hmm. And it's not permanent.
No. Well, I always said, I mean, we talked about it for a while when our office is on Long Island. So it's about 45 minutes outside the city. I used to do a reverse commute. So drive early, drive late. I always said it would be way easier. And, if it was driverless, because I could just leave and I could just work in the car and it wouldn't be a big deal. And also I think, once you kind of have a majority of driverless, it's probably going to eliminate a lot of traffic problems anyway, because you're not going to have dickheads swerving in and out and cut people off and creating the traffic. So I think it's going to solve a lot of those problems. And you're going to have the person that's willing to live an hour and a half, 2 hours away from their office, because again, they're probably not going to have to go in all the time, maybe just a couple of times a week. And they don't have to drive. They can just work in their car on the way to the office, go to their couple meetings, go back and forth, do what they have to do, and then go home and work in their car again. Now, the one thing I will say is I'm curious if it'll change when it goes driverless. I can't read in the car. I get sick. So I'm curious how that would affect me doing it. And I don't know how many people, I do know people get motion sickness. I'm curious how that will affect things. But I guess, look, if you're in a driverless car, you just tint the windows so you can't see it going by, and you're just in a box that happens to be moving. So, I'm sure there's a solution for that.
That's a really interesting point. Yeah, I can read in the car. My wife can't, and like, yeah, that's like I guess a competitive advantage like 10 years from now.
Well, that's like, I'm the same way. I can't. It's very difficult to read in the car. Extremely difficult. But I get plane, train. It doesn't matter. Does the driverless car become more of like that because it's constant? There's not the stop to go, the hit the brake or not, and I don't know. And it's an interesting thing to see how that dynamic shifts.
Yeah, the real estate. I guess I'm gonna go back to like this thing I learned that I almost like evangelize. Like the real estate industry has been like institutionalized. Or financialized. Like this is the other thing. My father, there was no MBAs in real estate like before 2000. Mm-hmm. And now it's like all Wharton, financial modeling. Oh my God. The obsession with financial modeling in real estate. So we've done at Fundrise, we've done like, I don't know how many, it was like 200 deals in the last like 10 years. And I've sitting with their team. They have really smart people, and they have done incredible models and stacks of underwriting. I said, okay, let's go back and look at the 200 models. Like, how many of them were right? Yeah. None? One? Like, how much time do you put into this thing that's always wrong?
It's funny. So I talk about that all the time. My underwriting is right here, right? It's a pen and a paper, because you want me to go 5, 7, 10 years. You want me to make some stuff up? Listen, I could use historical financials all day long and model it out, but the end of the day, you rob from Peter and pay Paul. This expense item's a little bit more. There's a little bit less. Your income's wrong here, but your other income's right there. I joke about it, because everyone wants to build a bigger model. And we get the question, what model do you use? I said, listen, you want me to send you a model? I'll send you 40 models I have on my computer. At the end of the day, your pen and paper, you're going to get pretty fucking close. And if you go back and you guys can look through a lot more deals than we can, you'll see that you're probably, at best, you're not even close to right.
Yeah. I mean, the model is supposed to help you think about it and like give a sense of like, oh, there's like resilience over here, or there's like a huge like upside over there, but it becomes the like output rather than the input. And like what you're doing is like once you like, if you do enough deals at some point, like, the model, you should be able to get there with like 3 to 5 really good assumptions are better than like 50 small, good, like, extremely like well thought out assumptions. It's just like, I worked in tech 9901, and like, I remember we had this 85-page model for this tech business. We were in tech real estate back then. And like we actually, what I found, we raised money from AT&T. We raised it. We were pre-product and we raised $16 million, $85 million valuation. Yeah. it was awesome.
Quiddy, that's all.
Yeah. Well, I mean, it was, I lived through the insanity of that, and like this is what institutional world's all about. The model was there to like give this sort of like, it was a sales tool. Mm-hmm. It was just a sales tool. It wasn't actually like really to help think through. It confused the business actually, because it just created this problem where I have this as a man. Now I've gone from doing deals to running an organization. And there's been this crazy learning curve around that. Like this is like when you have a small business, like a family. And then you go from like family, like a tribe, and then maybe like 50 people. And you go from tribe to village, and we're like at village level, and then village to city. And like all the organizational and cultural and communication like frameworks just break when you go from each transition to the next. And like where I have to spend my time. And so like one of the things I have to spend my time doing is getting people out of the weeds constantly. The technician always goes bottom up, always ends up at the like some minutia, and I have to be like, okay, wait a second, you give me this huge complex like spreadsheet with all the stuff you're managing or whatever it is, or like financial model, and we're going to stop here. I'm just going to ask you, like, right now, what matters most? Just tell me what matters most about the thing, this deal, this project, what matters most. And then they say it, I'm like, well, show me where that is here. And it's not going to be there. Like it's such a simple tool to like thought tool, but
can you give like a tangible example of that just to kind of drill in it? Because I think it's going to be important for a lot of people. Because like John said, we talked to 1,000 people that I think probably do get caught up in the weeds. And I'm curious if you can think of specific one that someone can take home.
Yeah, well, I mean, so like we run the company, and we're like still getting better at this. Around like we have like a framework to help people like think through what they're doing. Because what happens is everybody's doing, and people aren't really actually spending time thinking. And I say, okay, a 50-hour work week, like take an hour at the beginning of the week and don't turn off email, turn off your phone, turn off everything. And just think, okay, what am I doing here? What matters? How does it play out? And if you try to spend an hour thinking, you're going to get so anxious. You're going to get up and do the dishes. You're going to check your email. You're going to look at your texts. You're just going to like, because it's really difficult to actually like think through from the top down, not from the bottom up, not from like the little specific, like, well, is this like a 4.5 cap rate exit, or is it 4.75? Like that's where people go. So we have this framework, we call it OCS, objectives, challenges, strategies. And so you say, okay, like, well, just what's my objective here? So like, I'm trying to think of an example. We've gone into like the build to rent strategy recently. And so we'll say, okay, well, what's our actual objective? And then when you say, okay, let's say we're going to try to buy $500 million of build to rent, like in 2021. Like, and then we say, okay, well, what's the primary challenge to do that? Like what's the primary, and we'll say, okay, well, we're new entrants to the space, there's credibility.
Mm-hmm.
And you say, okay, well, what's the strategy? Like that's the primary problem. How do you go about overcoming like that challenge?
Mm-hmm.
And you'll find if you ask them a question, if I do like a session with you guys and say, okay, like let's do it together. Like, John, what's your objective? What are you working on? What's your objective? You'll state it, and it won't actually be constructed right. It won't be like time bound. It won't be measurable. Like it's actually there's a real like learning curve around like how to organize your thoughts. And it's like people just don't do it because no one's trained to do it mostly. And so they don't try to solve the right problem. They haven't identified the right problem. They actually don't have a clear idea of what they're trying to achieve.
Mm-hmm.
And so they just are less effective.
Yeah.
So I the question I ask all the time when someone when that I say, what are you trying to accomplish? Because you got to work backwards. Because if you're going about the process the wrong way by doing things that don't matter, what's the end? Let's work to get there, as opposed to let's try and figure out how to get there. I talk about that all the time because it's so true.
Yeah, that's what you just described is like exactly. So you have to do both. You have to do bottom up thinking. You start, you look at the rent roll, you get into the details, you bottom up, and then you got to do top down. It's like deductive versus inductive reasoning.
Mm-hmm.
And you need to do both. People are usually good at one or the other. Mostly they're biased in our industry towards the technical. And so, and if you start with where you sit, right? You sit where you stand, where you sit, right? You just like get constrained by all sorts of random assumptions. You're not actually working from where you want to be backwards. I mean, John, I think the exact same thing. And my father used to say, if you don't know where you're going, how do you know which way to go?
Yeah.
Spot on.
Yeah. I mean, I'm buying a 16 unit property for myself down in Florida. And I had a bunch of people ask me to like do a webinar on like the underwriting and my process and all that stuff. And I know a bunch of people probably got disappointed because I spent the first 30 minutes on why I chose the market and why I chose the neighborhoods I was looking for and like the reasoning behind them. Because for me, it was exactly what he said. It's like, okay, what am I trying to accomplish? And for me, it was, this is something I was looking to buy for the next 10, 15 years. I want to come in, renovate, refinance, and hold because I thought I can get a lot of my capital back, get the maximum amount of bang for my buck kind of thing. And I said, I want really good insulated areas that I think are going to do well for the next, 10 years. Obviously, I have no idea, but with the information I have, that was my goal. And I kind of went through that process of like why I'm looking at certain neighborhoods and why I'm targeting certain assets and things like that. I know tons of people were so disappointed because they wanted me to go into detail on like, oh, how did I do my rent comps and how did I do my sales comps? And it's like, yes, that stuff's all important once you actually have a deal, but you can't get deals until you know where you need to look and what you're looking for. And I think it's parallel to exactly what you were saying of like, you got to, as John said, you got to back into what you're looking for. And as you said, you got to understand, the objective and what you're trying to accomplish before you can actually go about solving that.
You also have to know the reason why people value that or overvalue that is because the industry tells them that's what's important. So any industry, you could be a doctor, a lawyer, financial engineer, but they always have three things. They have math, they have patterns, and they have cant or language. And they try to create complexity so that they get more highly paid.
Mm-hmm.
They're saying, well, like we have to use cap rate, which is just basically like PE, inverse of PE. Like they create all sorts of complexity so that you need to hire them. You can't penetrate it. Mm-hmm. It's meant to actually not actually simplify the life of somebody making a decision, meant to complicate it so that you need the professional. And there's another learning I have, which is like, okay, it sounds a little bit complicated, but like it's ontogeny recapitulates phylogeny. And what that means is that
I don't
the
understand
nature,
those words. So
yeah. Well, who the hell does? Right. So ontogeny is the nature of something. Like ontological is the nature of a fish is to swim because it's, and phylogeny is how something's structured. So the nature of something is just based on how it's structured. So of course, like fish have fins, birds have wings. So the financial industry has structured that have certain kinds of incentives. Like they're built around the middleman. Like hedge fund, the industry is built around the middleman. Hedge fund's a middleman. And those incentives or those structure will dictate how they behave. And so they have, for example, they get 20% profit interest on the upside, but they don't, no professional gives back their money, their bonus if it goes down. So they have like bad incentives around taking risk. And so if you understand sort of the structure of something, you can understand how it's likely to behave, and then you can take advantage of it. You can manage around it. This, like Munger says, tell me the incentives and I'll show you the outcomes.
Interesting. No, I think that's powerful. Definitely going to listen back, especially in this last part, and revisit it. But I think that's an awesome place to wrap up. We are coming up on time, and I really enjoy this. I'm sure anybody listening did. So maybe we'll have to schedule a part 2 in a few months from now and kind of revisit things we talked about, probably go into some other spaces. But Ben, thank you so much for coming on. People want to learn more about you, your company, follow you, get in touch with you. Where can they do all that stuff? I use Twitter a lot. I'm at Ben Millerize, like Fundrise, but Ben Miller Eyes. Or you get me on LinkedIn. Beautiful. Guys, awesome. Definitely go check out Fundrise. Definitely go hit him up on social media, follow him, interact with him, engage with him. Guys, thank you so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that you think would get a tremendous amount of value from this episode. Ben, once again, thank you so much for coming on. This was great.